One of the key assumptions you guys are making here, reading straight from your report, the weakening trend in the U.S. dollar, which has been ongoing for some time, has been accompanied by a definitive turn in real interest rates. How confident are you in that assumption?
Well, pretty confident. It began really the end of September, and the trade-weighted dollar is down over 10% since then. And that's associated with this changing pattern of global growth expectations. So as you've been talking about on your show, expectations for US growth have been falling away, as the US is in a very different phase of the monetary cycle from here in Asia, where expectations for growth in China are moving up really quite aggressively. So we've just raised our China GDP growth forecast for next year to 5.4%. If we're right, the Chinese economy next year will be growing 10 times as fast as the US economy, and that's a completely different environment from what we have, as it were, in the rearview mirror.
And Jonathan, I mean, there's a clear divorce between what's being reported in terms of this coronavirus reappearance in China with actually some of the evidence we're getting on the ground. Now, if we do see a massive surge continuing like this, I mean, how does that change the way you're looking at reopening, if you will? And could we see a reversal of policy? And that would, of course, be arguably a very, very big headwind.
Yeah, that's a great question. So essentially what we know about the Omicron variant is that it moves through populations extremely quickly. And that's what's happening in China right now. And that underpins our view that once you get through Chinese New Year at the end of January and you head through February and March, you'll see a very significant recovery in economic activity from exceptionally depressed levels right now, November, December. And what we think is going on right now is a really conclusion of a 2-year major slowdown in China, which is, of course, why Chinese equities and Hong Kong equities have struggled so much in the last 2 years. But that process has ended us up with valuations on some of the lowest that we've ever seen in the entire history of Hang Seng and MSCI China, and that's why we went more constructive a few weeks ago.
And Jonathan, given what your colleague Michael Wilson's been saying about the US market, how do you then look at earnings coming out of China and how are those targets evolving?
Well, if you look at MSCI China, it has almost zero sensitivity to US macro. So 95% of earnings are derived at home for the index constituents in China equities. And so essentially it all hinges on that relative GDP growth story. And what I would also say, take an index like the Hang Seng, something very unusual is now happening. The Hang Seng index is showing a negative beta to the S&P 500. That is, these moves that we're getting in the S&P 500 are no longer really affecting Hang Seng. It's all about the China reopening, the end of COVID zero in China, and this very significant monetary and fiscal stimulus that's also in place in China.
And you're looking at a bit of rotation, right? Just taking some money off the table in A shares, and possibly rotating full on Hong Kong now. It seems right now.
Yeah, so my colleague Laura Wang and I for several years now have preferred the A-shares market to offshore China. But if you look at relative valuations, and in particular the issue around PCAOB inspection, which seems to be heading in the right direction, we now have catalysts for foreigners to re-engage. And of course, the offshore China has a far bigger representation in consumer and consumer services. And that's where we expect this V-shaped recovery to be most evident.
How would you describe institutional positioning right now in Chinese assets, Jonathan?
Well, if you look at the long-only community overall, the data that we have suggests that compared to the peak, which was at the end of 2020 and early 2021, those positions are down by about 2/3 from the peak. Now, partly, of course, that's because the benchmark index weighting has declined, but people have also been steady and persistent sellers. Hedge fund positioning 6 or 8 weeks ago was pretty well flat, and now certainly it is the case, obviously the market's up a lot, that there's been some re-engagement from those kinds of accounts already.